Okay, I was asked the question, what's the difference between a direct offering and a public offering? And the reason this came up, Kiki B asked the question. This was the big player today, AYRO, had this big, in the pre-market from 325, opens at, 4.5 and runs to 8.25. Then it starts to spike again, and they announce that they're doing a direct offering. Stock at 475. Stock gets halted, opens lower around the 5.25 area, 5, and is holding in this area now. But you can, as we know, whether it's a public offering or a direct offering, you can see the negative effect when you price it at a significant discount to the existing market. So the main difference between a direct offering and a public offering is the involvement of a brokerage firm. When you do a direct offering, you just sell shares from Treasury to investors without using a brokerage firm to market the stock for you, for them to use their clients. So quite often what it'll be is somebody approaches you and says, hey, I want to do a private placement in your company, and an institution or something like that. We like the deal. We can't buy stock out of the market without affecting it. We want some stock, and so they do a direct offering to the institution. You can also do a direct offering. No, you can't really. I mean, you can. What happens sometimes is you get, if it's a bit of a shady operation, because this is not really, there's some ways around it, but it's not really, it's in the gray area. You have investors that have big positions. They sell their big position up here, let's say at 7, between 7 and 8, and then they take the direct offering now because they have cash because they sold their stock. They're from their long position. It's a bona fide position that they had. They sell it, and then they go to the company, or the company says, okay, hey, look, big position holders, you sell your stock, we'll run the stock up, you sell your stock into it, and then replace your stock at 475 in a direct offering. So that's what a direct offering is. And I'll get to the positive and negatives of that in a second. Now, a public offering is where a brokerage firm is hired, and they're paid a commission to raise money for you. And it can be done at 475 as well. You see that all the time, that a company is doing an offering at the market with a broker. The brokers quite often will also, along with the fees that they collect, commission that they get, they also get warrants or options to buy additional stock at additional prices called broker warrants, broker options, and they can then, if they sold this to their clients at 475, they also get an option to buy probably 10% of the stock that was issued as an option at the same price, 475. So that's how the broker makes money. So those are the two types of offerings, direct and public. What's the negative and the positives? Well, both can be negative, both can be positive. I mean, whenever you do a financing, you're putting money in the treasury. So in this case, though, it's quite dilutive because the stock was trading at 7. Now it's 5. But is it really dilutive? Because here it was just a day ago at 250. They pumped it up. Now they're doing it at 475. So really, for existing shareholders back in here, it's a very great deal. Those investors that, or traders, whatever, that bought it up here, they got whacked. But so really, this is a good deal for AYRO, the longer term shareholders. Here at 250, they do a financing at 475. So this is, it's a good deal for those shareholders. But it could have been a direct, or it could have been an offering through a broker. That doesn't really make much difference. The difference could be, one of the other differences, though, is if it's through a broker, they're selling it to their clients. And the stock may or may not be registered. That's a separate issue. But if it is registered, you would tend to see more people putting pressure on the market, selling it as soon as there's a profit. If it's an institution that's taken it down through the broker or through a direct offering, they would tend to be longer term holders and hold the stock. So there is not necessarily a different and positive or negative between a broker and a direct, depending on the level of sophistication or the tier 1, 2, 3, 4 of the brokers. I mean, if they're a shady house, and you've got options against you, plus clients. It's going to be 10 cents or 10 minutes, whatever, sooner for them to get out of their paper because they want to move on. The broker wants to move on to the next deal. So that can be negative. But if it's a big brokerage firm, we've seen this happen on some of these higher price stocks where the stock is done just below the market, yet the stock continues to rocket higher because the stock is in great demand, and institutions can't get a position because without affecting the market. So they do a private placement. The private placement gets oversubscribed, and boom, you can see the market continue to trade higher. But that's a separate issue that's not really direct or public. That's supply and demand. So those are the two main differences between public and private offer. Between a direct offering and a public offering. Kiki asked the question, so the shares are already essentially spoken for. So if the one company sells their shares at a profit and now has cash to buy more, there's really dilution going on. Is there really dilution going on, or is that one company? You said no. Okay, so that's my point. If you're a private investor, or an institution of some kind, you own stock in this company. It goes up to here. You sell that stock. Then you do a deal with the company and you buy back the stock, but from Treasury. So it's new stock being issued, so it increases the float. So it is dilution in a sense, though in this case it would be anti-dilutive because the stock was at 2 and they did it at 4. They did it at 475. So they did it at twice, the 30-day average, which would be it's a big winner for existing shareholders. The only people that got smoked are the ones that are trading it up here. So so it is dilutive in the sense that there's going to be additional shares issued. It's anti-dilutive because the book value of the company goes up from where it was here at $3.25 a share to here, what it is now at $5.40 a share, plus all the extra stock. So the book value by the money that's being added, at $4.75, makes this transaction anti-dilutive. But that's just a really matter of semantics.